China announces dramatic plans for a new Hong Kong security law. A third of US adults have delayed or avoided getting medical care during the coronavirus outbreak, according to estimates. And one of Australia's largest asset managers sees increased opportunities in direct lending. Here are some of the things people in markets are talking about today. Crackdown: Hong Kong's status as an international financial center is in jeopardy, opposition lawmakers warned, after China announced dramatic plans to rein in dissent by writing a new national security law into the city's charter. The regulation would curb secession, sedition, foreign interference and terrorism in the former British colony, local media reported Thursday, citing unidentified people. Protesters urged democracy advocates to hold rallies across the city Thursday night, but mass demonstrations didn't immediately materialize. More details will be made public Friday, when Chinese Premier Li Keqiang is slated to deliver a speech at the opening meeting of the National People's Congress. 3- and 12-month forwards on the Hong Kong dollar rose in New York trading, indicating further weakness ahead for the currency, which slipped the most in 6 weeks earlier in the day. Meanwhile, 2 US senators are proposing legislation to punish Chinese entities involved in enforcing the proposed new security laws, and penalize banks that do business with those entities, adding to a growing list of initiatives in Congress aimed at China's government. Markets tepid. Asian stocks look set for a cautious start Friday as rising tension between the US and China added to concern about the pace of economic recovery from the coronavirus pandemic. The dollar was steady and Treasury yields dipped. Futures pointed lower in Japan and Hong Kong, and were little changed in Australia. China responded to accusations from President Donald Trump, warning that it will safeguard its sovereignty, security and interests, and threatened countermeasures, dragging down a big Hong Kong exchange-traded fund by almost 4%. The S&P 500 declined 0.8%, with signs mounting that Trump will make his tough on China stance a key element of his re-election bid. The energy, technology and utilities sectors led the losses. Elsewhere, crude oil rebounded from an earlier swoon and gold declined. Virus update: a third of US adults, about 94 million people, have delayed or avoided getting medical care during the outbreak, the Census Bureau estimates. A report from a London college estimates 4.1% of the US population is infected. Also, the FDA put out a list of 27 antibody tests that can no longer be sold in the US for lack of proper vetting. Meanwhile, the Treasury Secretary signaled a need for more US economic stimulus, and major job losses mounted as more than 2 million Americans applied for unemployment benefits last week. New York canceled in-class summer school. Starbucks is seeing a rebound in sales at coffee shops, and Facebook is now letting some employees work from home permanently. Around the world, cases have now topped 5 million, with deaths exceeding 329,000. Here's how Bloomberg is tracking the developments. Interesting: as Chinese companies face increasing barriers to selling shares on US exchanges, Hong Kong is emerging as their most likely alternative. That could further destabilize the city's already volatile interest rates. Mega listings like Alibaba's late last year tend to mop up liquidity as investors set aside cash to buy stock. It drives up HIBOR, which affects the cost of everything from mortgages to corporate loans, and can linger after big share sales. Higher rates also tend to support Hong Kong's pegged currency, which is already trading near the strongest it can technically trade versus the greenback. Margin financing around large listings further squeezes liquidity in Hong Kong's banking system. The 1-month interbank rate hit its highest since 2008 in the months leading up to Alibaba's share sale. Xiaomi's offering in 2018 had also sent HIBOR to an almost decade high. A more direct approach: one of Australia's largest asset managers sees increased opportunities in direct lending as companies impacted by the COVID-19 crisis seek access to capital. IFM Investors, with 156 billion Australian dollars ($102 billion) in funds under management, says the economic recovery from the pandemic will take years and expects struggling firms, from childcare centres to property developers and retail and commercial property landlords, to need financing. You still have businesses that have very good long-term fundamentals, but they need some support during this interim period, and that's what we are looking at, said Hiran Wanigasekera, an executive director of debt investments at the Melbourne-based fund. We are looking at how do we come in and plug the funding gap that they need.